And of course, today we're coming to you with a great topic, which is all about multi-time frame analysis. How do we trade like a ninja? How do we break down things a little bit differently? And some of the tips and tricks that we've learned over the years that really help us differentiate ourselves from other market participants. How can we possibly better understand where Wall Street and other large institutions actually place their orders? We've got some great live examples in today's session as well, which I think you'll really enjoy. And of course, I'm really interested to see your comments. So, as always, if you have questions, please post those questions in the chat. And of course, we'll answer them throughout, or we'll answer them at the end and throughout the session. So, make sure if you have a question, just ask it. It's that easy. And there's no stupid questions in this world. The thing is, there's always another person that's always going to have a very similar one to you. All right, so let's jump into talking about what we're going to be covering today, which is, of course, a heightened perspective of multi-time frame analysis. As we mentioned, we'll be going through quite a few things here, including the Q&A. We'll be developing our skills of leveraging multi-time frame analysis. By the end of the session, we'll be looking at seamlessly integrating some of those insights into the multi-time frame approach. And of course, we'll learn with some tips and tricks that I think will help everybody to potentially build into their systems and strategies. Just before we get started, a quick reminder that we have a general disclaimer. We'll be back in just a few seconds after we show this. Okay, so unlocking the trading secrets of better understanding of multi-time frame analysis. How can this change our trading careers? Can it change the way we actually understand markets? Well, it turns out, yes, I believe it can. And of course, today we'll go through that. How do banks and institutions actually enter market positions? A live example breaking down some market structure, why we need to use the word structure a little bit more when it comes to better understanding whether you're a scalper, day trader, or investor, or even swing trader. And then, of course, a basic yet effective way we might be able to tell we're in accumulation or distribution zones, a form of structure that's creating. All right, let's go through one of my favorite quotes of all time, which is one from Stanley Druckenmiller. And it says, "The first thing I heard when I got into the business, not from my mentor, was bulls make money, bears make money, and pigs get slaughtered." I'm here to tell you I was a pig, and I strongly believe the only way to make long-term returns in our business that are superior is by being a pig. Effectively, Druckenmiller was telling us something very important here. He was saying, you have to think about markets a little bit differently. And like Wyckoff, you have to study a force. You have to start to figure out who is more powerful, which side is really winning. And can you see that using price action? Stanley Druckenmiller, if you don't know, was one of the best investors of all time. I liken him to pretty much the best trader ever, or we're very much up there in the tops, because not only did he take billions of dollars and make superior returns, I think he averaged 30% for something like 15 years or something like that on the markets, but he did it on massive money, which is just not as easy. It's easier for us to be trading like ninjas or fast and nimble in smaller accounts than it is for somebody that's trading billions of dollars. They have to position in a certain way. And the reason we bring this quote up is because we have to talk about positioning. Now, funnily enough, we have the Australian US dollar example here. And if you're watching this video at the time that this is uploaded, you go back and have a look at the Australian structure. We'll look at that very soon because it's very similar to what we're actually seeing on this chart. The market has come down to a level and it's found buying pressure. How do these large institutions actually enter into market? Remember, they enter with positions. In fact, they are position-based traders. They don't necessarily do what you and I might think. We think, okay, let's enter the position, buy. Okay, we buy, we place a stop loss below, and we place a take profit, hopefully, somewhere in the future. Now, what a lot of the time happens, and I'll be my first to put my hand up and say this has happened to me many times in my trading career, is the market will come down and it will take our stop loss, and we call that a stop loss hunt in many ways, and then it will go off in the direction. You think you're left scratching your head saying, what just happened? And how come the market is trading against me? Have you ever had that type of thing? Let us know in the comments. So the one thing with this is that basically markets are all about building a position. If we think of it as 70 cents here was cheap, 71 cents was fair value, and 72 cents was expensive or premium, as the market comes down, institutions will buy larger quantities as it gets into the lower levels. Now, they'll have a mandate. That mandate will say we'll buy between 70 and 72, but we won't buy outside of those parameters by some form of percentage, whatever that might be, standard deviation, whatever. And they're basically just interested here. Remember, it's all about the way that you interpret this structure, and we'll look at that very soon. So we'll come back to this example in the live markets and take a look at some examples there. One of my other favorites is not so much a quote, but it's a theory. And this is the Wyckoff third law, which is the law of effort versus result. Now, Wyckoff basically said that states of change in markets or an instrument's price were a result of an effort that generally represented by trading volume. If a currency such as the Australian US dollar started to consolidate with a very high volume after a long bearish stint, so again, market comes down, it starts to consolidate, something like this, then we might be needing to look at this to see whether we can become pigs and think about things differently. You'll find that pretty much whether you're somebody that likes support resistance, supply demand, or any other real concept, you will tend to find that there are very similar types of concepts around those. So actually, a lot of the time with technical analysis theories, they all come down to very, very similar things. So I think that's something that's really important for us to recognize when it comes to these markets. So anyway, here we have, of course, the laws of return or law of effort versus result. And this is one of my favorites, which is that when we have that sideways action, what does the volume tell us underneath? Is the volume bullish? Is the volume super bullish? Is the volume, not very big? Has it remain consistent through that build structure? These are little clues that we can get as traders. And of course, we will be looking for those. So Wyckoff's composite man theory, an easy way to understand maybe the idea of positioning and how the larger traders actually do it. And that was to say, okay, we have Cocoa Puff brains. Maybe we can't understand everything in the world. We need to simplify things. You'll notice that anyone that truly understands the concept, often they will break things back down into their simplest forms. And one of the simplest forms is the composite man. Let's just say that everybody that's trading in the markets is basically trading against us. That's institutions, hedge funds, Wall Street, everybody else. And it's all one entity. That one entity versus us. Can we see where they are positioning in? And if we are able to recognize that positioning in, then we could potentially get an advantage. And that's what Wyckoff was trying to get at. Let's just say, okay, it's all one entity, much simpler for us to understand. Now can we see what they're trying to do? What is that entity trying to do? Who is winning? What's the study of force? Who is the pig? This is something we want to be thinking about when we approach structure. So let's now take a look at a live example, and we'll jump into the charts and we'll go through one that's just happened very recently. By the way, if you enjoy this type of stuff, make sure that you give it a thumbs up and press the like button. It does help us out. Okay, let's move over here to the charts and start off with one that I think a lot of people will have been talking about this week, which is going to be the Australian dollar. So here we've got the Australian dollar. And what we're going to do is a multi-time frame approach here with the Australian dollar. We're going to break it down from the monthly down to the weekly, down to the daily, and understand this structure a little bit better. So what you might notice is that when you come in and you might be trading a 5-minute, 1 minute, 3-minute, or even 10-minute chart, you're probably going to discount the monthly time frame. Now, that's okay, I guess, but it's still not the smartest way. It doesn't take, monthly candle takes a long time to close. It's every month. So there's no harm in coming up to the higher time frames to understand where you're at in the markets. So if you have a look at this monthly, and we were thinking about it from a support resistance standpoint, what you might notice is that we have some key levels. So if we get a horizontal line and we put it across the bottom, then here, across this area down here, we tend to have a lot of wicks and previous buy zones. This is a critical point for the Australian dollar. Basically, it's a level that we haven't reached since 2008, 2009. Then we reached in 2020 during the crisis. And then, of course, we reached it one other time, which was November of 22. We just reached it again. Now, the overall trend is down. There's no doubt about that. The monthly is telling us. But we might want to put a line on the charts and just recognize this, and also recognize there's been a decent amount of trade volume going through currencies recently. Then what we could do is we can come down to the weekly and we can say, okay, well, what do we notice about the weekly? Are there some things that we can start to build together? one of the things that I instantly notice is that we seem to be making a series of lower peaks and lower troughs as we come down overall. And if that does change in the future, it's maybe something I would want to know about. One of the great things about the Pepperstone platform is that you'll be able to set alerts. Let's say we set an alert if we break past this particular trend line down, and we can just pop that alert in the chart. This is the power of multi-time frame analysis, and also thinking about what maybe a large institution would do. So what would a large institution do here? Well, of course, it's a critical point that we've seen on the monthly. We can see previously in 2022, it held up around here. So it's clearly a level of support or demand, and that there may be structure that forms here. The key to that is there may be. We don't know that yet. We just know that we might be interested in this zone that comes down to this level, and you go, oh, okay, now let's see how it plays out. So if we scroll in a little bit and we look at the weekly, that's when we'll start to recognize whether we believe we've had some positions in. And you'll notice that the market comes down very quickly, and then it starts to stop, and it goes up and it rejects with a wick, and it goes up and it rejects with a wick. And it keeps doing that for a while, creating a series of doji and rejection wicks that then break down. Now, the key to all of this is that notice that the pretty much the trend remains very negative. We've got wick rejection, wick rejection, wick rejection, wick rejection, and it keeps going wick rejection, and then suddenly something changes here. This is the pig-like moment in many ways when it comes to action in markets. And although we're still on a weekly time frame, and you still might be saying, well, I want to trade a 5-minute or a 2-minute or anything like that, it's this understanding of the higher timeframes that can help you in positioning and help you to understand bias that you might have as well on a 5-minute, 3-minute chart. So straight away, we can say, okay, wait, does this weekly matter? Now, if you've been following everything that's been going on recently, you would notice that the Australian dollar, the key here was that we saw an interest rate hike rumor coming through. And it turned out that it was about 80% likelihood that we'd have an interest rate hike. We saw what we call a buy the rumor, which was this giant candle, which closed above many of these wicks. And that's actually a positional based change. That means that people in the composite man were probably starting to position differently after this candle. Then straight after the interest rate goes up, we actually see a sell-off. And this is one of those classic kind of trap style zones that you often do see when it comes to currencies, commodities, stocks, indices, doesn't really matter. It happens to all these things. It'll be a buy the rumor, sell the fact. It'll go against what you think should be happening on the charts. So that's one of the first things you want to be doing whenever you're looking at these charts, monthly into weekly. Then we go into the daily and we start to look at this structure, and we can say, okay, well, wait a second. We have a few movements here. We've got a market that's made a base. It's come down. It's forced its way through here. And then something very interesting has happened at this point. The market pushed to a new low, but then instantly rejected back up against that and went on this huge rally, this buy the rumor rally. Do you think that could be something that's very important for us to recognize on charts? I would argue it is, because we already know it's at a monthly level, it's at a weekly level on the higher time frames. It's created a structural change potentially, especially with the weekly close. And that means that if this market pulls back after that point, maybe we want to be looking at some form of buy, which is, of course, what did happen. But then if that keeps leading into a break of that trend line, then that could be something where we start to see even further buying pressure start to come into this market, and a complete change of trend from being suddenly what was once negative turns into a bullish style position, where actually the total market, that is the composite man, starts to move in the bullish direction. If you then had some kind of, let's say, bullish bias, if that's what you were creating and that's what you recognized in the price action structure, then that's possibly a level that you might say, okay, well, now on the smaller timeframes, I might look at buy only because it makes sense. So it's that deeper understanding of market positioning that's really important. Weeklies matter, monthlies matter, dailies matter. And it should be something that we bring into all of our analysis when it comes down to scalping, day trading, swing trading, or investing. All right. Let's go back over and answer this one. So, where does the big money hide when trading markets? how can potentially volume profiles be used with multi-time frame analysis to help us gain a better chart understanding? How do we recognize key levels of market equilibrium? How do we see supply and demand when it comes to these charts? And of course, whether there's any examples that we can use on the charts in terms of the volume profile and how it interacts with market structure. So one of the things is, what is a volume profile? We always get asked this question. Well, the volume profile is a relatively new tool. It's something that we haven't seen necessarily hugely used in, let's call it, the markets and the retail platforms for many years, until I would say about 4 to 5 years ago, where it became really popular and it started to get that kind of traction. Now, luckily for you, if you do have the Pepperstone connection with TradingView and you have a pro subscription, then you'll be able to get this excellent tool. And we'll show you why it could be something that you might want to consider in your analysis, whether you're a currency trader, whether you're a commodities trader, or whether you're a stock or index positioner. So volume profiles are basically a horizontal graph depicting the volume traded at a specific price over a specified period. What distinguishes this from a traditional horizontal volume, which is more of this vertical kind of thing here where we've got this, is that it allows you to see how many trades are occurred at each price point for the specified period. Volume profiles can show us the market's equilibrium or where orders sit within the market. So traditionally, volume will look like this when you post it onto a chart. The problem with that one is it doesn't really tell us much. It just says, okay, for that particular day or that particular 1 hour chart or 5 minute chart or 10-minute chart, you have a large amount of volume. What if you had price action? So these are candles. Draw some candles here on the screen. What if you had price action and you were able to actually say, okay, the most traded volume went through right there? Would that be helpful? It's more helpful than just saying, okay, on that one candle, there's a large amount of trade. And this is where the game changer comes in for retail traders. This is something that's really helped multi-time frame analysis in particular, and why position-based trading concepts can be used quite easily by us as retail traders to recognize what possibly the composite man or Wall Street are actually doing in markets. So what's a volume profile made up of? It's made up of really three main reads. You've got what we call a value area high, which basically is the high line. You've got the value area low, which is the low line. That's where 70% of the total trade volume has been stuck between the value area low and the value area high. And then you have probably the most important one, which is the one that's going to come up, which is called the point of control. And the point of control is the single price level where the most volume was traded, and that area represents the area which has the most potential open trading positions. And that's what we're all about. We're trying to understand, where does Wall Street, the composite man, place their positions? Where do we see the biggest amount of entries? And therefore, what is going to be most likely a defended zone on the markets? If we saw market structure around those times on a smaller time frame, would we care? Well, the answer is yes. Now, why should we not change the volume profile platform stuff? Well, it basically is pretty much spot on when it comes out. Remember, with any indicator, it is better that we don't change most of the settings. We can fandangle things a little bit too much, and it doesn't always work out for us. So I like to think of it as we keep them at the standard. And one of the reasons you want 70% is because it comes back to normal distribution theory, which is usually 68.26% in terms of fair value, one standard deviation. And that's something that's in the options world as well. And you'll find that it's in a lot of mathematics. So normal distribution theory, keep it at the 70. That's at least a suggestion for today. What does a volume profile look like? It'll look like something like this. And you can see that we have a volume profile just plugged between the high and the low over here on the left-hand side of the S&P 500. That's one example. Here's another example of gold. And you might find that this is pretty hilarious when we start looking at things very, very soon, and we start talking about gold and where it's been, because of course this is an older slide and gold has done some interesting stuff since this point. So this is again a low to a high style scenario of the volume profile. We have some supply and demand as well that's there in the box. Okay, so why does this matter? Well, let's go and have a look at a live example. So we'll jump on into the charts and we'll have a look here at the Australian US dollar. And we've already talked a little bit about structure. And this is, of course, a pretty good looking structure that's been happening on the Australian dollar. But what if we were to grab a fixed range volume profile, which is probably my preferred volume profile, and we'll pull it over a range? Now, what I'm interested in here is I'm interested in breaking down ranges. There's obviously going to be a range of this entire structure. Then there's going to be the range of this area here, which begins this secondary structural creation. And that's also where we have a little bit of a trap potentially down here in the lows. Now, what you'll notice is we have a point of control. And the market came back recently this week to that point of control. So at the time of this recording of this video, we actually have seen this reach the point of control, reach the most traded position. We know that that's literally the most traded position of that structure. And funnily enough, it had a reaction off it. So if we could do our multi-time frame analysis, if we could work this out ahead of time, which of course you'll notice I'm using data before this occurred. So I'm using this structure here between the left and the right. This is the fixed range volume profile, by the way. Then it might help us to find an area or zone that we could then target on the smaller timeframes with our trading systems. So this is just an example of how we could use fixed range volume profile on a really nice structure here on the Australian dollar. Now, of course, you can do this on so many different pairs and so many different scenarios. If we go have a look here at the gold example from before, you would have noticed that we had a volume profile POC that sat around 1840. Now, 1840 just so happens to be very close to where gold ended up going down to, and then, of course, finding that buying pressure. So that's something that you can do. And again, with volume profiles, a lot of the time, what I like to do is I like to grab it between the high and the low, or the low and the high, and break down that structure. So here you can see the high to the low. You get this pretty clear value area high and point of control that is in this very tight zone through here. So let's say you had bought gold down here and you're saying, well, where's my take profit maybe going to be? Well, a good way of using volume profile to understand where other market positions would be to say, okay, well, if the market comes back up to this price, maybe I want to consider taking some profit. And you'll notice that that actually makes a lot of sense with standard support, resistance, and supply demand dynamics. Here we have supply, 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 resistance across the whole thing as well. And we end up getting a pretty nice little target in here. Now, as it go a little bit higher, sure, you're not going to always be able to get every single piece of the percentage, but ideally we'll get as much as we can. And in this case, of course, we get that rally into this zone. So yeah, a very, very good example of volume profile in front of the charts. And of course, a new tool that you could add to your market structure creation and to your multi-time frame analysis. Remember, the market's a fractal. So what that means is that really when you're talking about market structure, we all look at 1 hours, dailies, weeklies, and all these arbitrary numbers that we like as human beings. But algorithms and a lot of what Wall Street trades with, they'll be trading 45-minute chart, 47-minute chart, 1 hour, 27-minute chart. What you'll need to think about instead is rather than looking at just a candle pattern, you want to be starting to think about positions. Where are the positions? Where should I be looking to activate my systems? And a lot of the time, that's going to be around defended zones that volume profile can help us with. Okay, pattern recognition mastery, unveiling the blueprint behind pattern recognition, and more importantly, can patterns help us as multi-time frame traders? How do we better understand how patterns can help us as a trader, how to recognize support and resistance a little bit better as well, and of course, examples that have shown up on the charts in recent times. So we'll look at some live examples to work that out. Also, could we use them with something like a volume profile tool? Well, first up, before we're a pattern trader, before we're even considering multi-time frame analysis patterns, we must trade liquid pairs. It's all about, patterns are about creation of structure, and therefore, whether it's a head and shoulders, an ascending triangle, a double bottom, a triple bottom, any of these types of things, it's based on that we're recognizing something that's happening with large traders that is going to give us edge because they're positioning in a certain way. So if you want to be a pattern trader, it's very important that you do consider trading very liquid pairs. some thought processes behind that: major gold pairs, US pairs, major crosses in currency, things like oil as well could be considered, major indices, S&P 500, NASDAQ, Russell, DAX, FTSE. These types of ones always have a lot of trade. A pattern trader also needs to recognize, when is a pattern forming? Does it make some sense? A lot of patterns, especially the consolidation pattern, let's consider we have an inverse head and shoulders. So we'll go inverse head and shoulders, something like this, and then it breaks out. When could these patterns being formed? This is effectively a range-bound market. Some people will call it a supply in this case. Some people will call it a channel if you're a pattern-based trader. When that's creating, there is a good chance that there is probably no news during this time, so no catalyst towards a bullish kind of position, and the other, or bearish position. And also another thing that we can consider is it might be happening during the late US session into the Asian session, therefore lower volatility and usually lower ranges being made. So has the pattern formed during those times? If it has, could that be stronger? I would argue, yes, it could be, because what's probably going to trigger a pattern break? An opening of some of the highest liquidity, things like the London session, or the overlap between the London session into the US session can be incredible times to see patterns break. Again, it's just common logic, and I'm sure most of us have thought of this out there, but I often find that just you hear these little bits of tips and tricks and you go, well, yeah, I guess that's right. If a pattern breaks into something like the London session or the overlap session, that's probably going to be a stronger breakout because it's going for the liquidity. There could also be traps of breaks during that time that you could take advantage of as well. So when patterns form, think about the structure, think about all of that. It's always really important. But let's jump into some live charts here and have a look at how patterns could help us as traders. So first up, let's have a look at the Australian ASX 200 right now, which is an index. And whether there's actually a few other ones here and indices that look very similar, but most of you will probably recognize this pattern straight away as an inverse head and shoulders. You've got the left shoulder here, you've got the head, you've got a right shoulder in this area here, and of course, you're seeing that strength coming through to the neckline at this point. Now, there's a few things going on here. The first thing is that we've had kind of like a downward trend line. And you'll notice me mentioning a downward trend line in a lot of these live examples because there are so many breakouts of downward trend lines going on at this time of this recording. The first thing is that actually what a lot of this was it was what we call a descending channel. So it's not easy to recognize these, but there are secret kind of like techniques that you could use. Generally, when you're trying to recognize any type of trend line, you're looking for a sequence of two events. In this case, we have a high, we have a low, we have a lower high, and then we get a lower low, okay? Once the lower low happens, that's what we call the first touch. We've got this first one, we've got this second one. Now, if the market comes up again, it's probably fair for us to say that there could be a reaction here. And if there is a reaction there, then of course that becomes that kind of self-fulfilling prophecy. So this one could be actually predicted based on this high, low, lower high break and then pull back to the same zone. Because we now have some kind of pattern recognition happening, that's when we could say, okay, that's a trend line we want to follow. The same thing's happening here where we have a sequence on the bottom end, and that becomes the bottom end channeling line. So what we've actually had here was a descending channel. And descending channels aren't always that common. Sometimes they happen in currencies, sometimes they happen in the indices. And when they do happen, it usually marks the very technical trading, because what that really is telling you is it's kind of like 2 steps down, 1 step back, 2 steps down, 1 step back, 2 steps down, etc., etc. But when they break out, it means something. And that's exactly what we've seen here on the right-hand side. And so far formed, of course, a inverse head and shoulders. Now, a lot of people would say an inverse head and shoulders, what are you going to do with that? Well, traditionally, an inverse head and shoulders from a technical based standpoint, and remember, these are not guarantees. It's a pattern. It's just an example here on the charts. They would usually go around the distance of the head to the neckline. Now, an example like this, depending on whether you draw the horizontal or you're drawing this kind of vertical line, you're going to pull this area up, and then you're going to recognize whether that goes back into a technical zone. In this case, it's going to a resistance area that's up here in the highs. Now, that's what I like to call proofing or market proofing. Now, does it strengthen the pattern? It makes it better. And it's certainly something that we do look for on charts. And of course, it's something that we do see on this particular one. But let's jump on over to another one. Here is another one that's formed, and it's the index IWM, the Russell 2000. So the Russell 2000, another inverse head and shoulders, this time on a neckline towards the breakdown. And that actually is broken out. So that's actually showing you a bit of a breakout. Again, is it head and shoulders the best pattern? It's often considered something that people like, but I think there's a lot more to the charts than this. And again, you'll notice that if we think about trend lines, we've also got a nice break of the trend line. So we've basically got this really strong descending channel, which is 2 steps back, 1 step forward kind of thing that's going on. And then we've broken through this top end range, which is relatively significant, and it's helping to kind of create a better storyline. That's again just an example of things. Some other notable patterns that you may have seen on this chart, if you're looking at it, would be, of course, the channel over here. A great rule when you're looking for channels is the 1122. And what that means, you've got one touch to the upside, you've got one touch to the downside, you've got a secondary touch to the upside, and you've got a secondary touch to the downside. Upon a 1122, you become trapped. The third, the fourth, the fifth, the sixth, the seventh, however long it goes on for, becomes kind of that self-fulfilling prophecy. So I like the 1122, and it helps you get out of kind of tougher situations. So you may be like 112 and 2 and something like that, and it might fail straight away. And you go, okay, well, did I see the activation up there? You know, these are the types of things that you are looking for, though, in ranges. And actually, it was 1-1-2-2, 1 trade up. That's how you would look at it. So in this essence, it's just an example here of a couple of things that have happened recently. You've got that beautiful channel here. You've got one that's a little bit dodgier here. You've got that trend line down with a head and shoulders, and you can recognize them showing up in charts. Let's have a look at another example in front of charts now as well. And this one's a currency example. So what have we seen recently happening with the euro? Well, a very consistent downward descending channel. So you can see here, incredibly consistent, very aggressive towards the short side, and then something changes down here, and it actually creates a basing formation. Now, to bring together a couple of concepts, if we went to a weekly or a monthly chart, what you might notice is that we're back on these weekly lows. So again, multi-time frame analysis helping us out to possibly recognize something. Notice the wicks here, the wicks showing strength. Then we've got this rejection wick. Then suddenly we go bullish here. And of course, then we have that huge breakout candle showing us that positions have changed. Once we break the trend line and we see all of these things kind of occur, again, it can help us as investors, traders, scalpers, day traders, all of those types of things on the smaller time frames. This is something that can really help. And hopefully, recognizing patterns, you can start to think of it as positions in the market. And I think that's something that really strengthens us as traders. All right. Well, we'll hand it over to some questions now. Now, always a reminder, if you do enjoy these types of things, make sure to give it a thumbs up. And of course, smash the like button as well. It does help us out, no matter what platform you're watching this one on. And yeah, I wanted to just hand it over to some questions if anyone does have any, and let us know right now. Of course, be more than happy to answer them as soon as we can. One question I did get from somebody that I thought in the comments section that I thought I might answer was a question around the idea of using moving averages and whether there were better ones or worse ones. And we've answered this quite a few times, but I thought I'd just answer it right now. So in general, we like the 20 EMA, the 50 EMA, and the 200 EMA, or 200, sorry, SMA. Some other notables that could be used, 100 SMA is quite popular. And the reason why we actually got these numbers is a few things. I like the 20 the most because the 20 effectively represents around the right amount of trade days for a month. So if you think about it, we have 5 trade days in a week, and then you times that by, on average, let's say 4 weeks of the year, 4 weeks of a month. So we get about 20, and that's where it comes from. But the 50, the 200, the 100 are actually used by institutions. So if you have a look at institutional write-ups, whether it's like, I won't mention any in particular, but let's just say any big bank, and you are privy to some of their write-ups that they tend to put out, they often will mention the 200 SMA, the 20, those two are quite popular. And you'll also see the 50 used a lot as well with cross techniques. Now, the cross techniques themselves don't tend to work, even though they have very fancy names such as the death cross and stuff like that. But what they do is they can show you strength of a market, breadth of a market, those types of things. Percentage of stocks above 20 or above a 50 is a common one that people use. Another one about the 200, a good little cheat technique to try to figure out trend, has often been considered if price is above the 200 moving average, then in general, let's say on the daily, so 200 daily, then that may mean that we're actually in an upward trend. If the price is below, then we're in a downward trend until it breaches back above. It's kind of like a cheat technique that a lot of people use in currencies, and they also use it in stocks and commodities. Okay, here's another question coming in from Trading Leprechaun. It says, if you fancy a slightly off-topic question, fancy expanding on the use of ADX and your general opinion on how it's used on higher timeframes. Yeah, I mean, we probably the question is interesting. ADX is not really something that I use a huge amount in the charts. I used to use it a little bit, but I find that it's not really one that I always focus on. What we might do is we might save that for a topic. I'm writing a few topics, so I'll tell you what we'll do is make sure you subscribe to the YouTube channel here and to the TradingView platform over on Pepperstone. And what I'll do is I'll do a write down on it so you can actually see how we use ADX, because I've got that twice now. So we'll actually explain ADX in detail and we'll do a special for it. Okay. So I am writing a couple of topics at the moment. So that's good feedback. So we'll do that one for you, Trading Leprechaun. So look forward to that over the next coming weeks. We'll actually do an ADX one. Probably about 1.5 months, I would say, away from here. Avery 100 says, how long do you usually exit your trades? How long do you usually exit your trades? Intraday, your example suggests holding several days, but then swap fees apply. What is your view on this? Well, it depends on your time frame analysis. So I do all sorts of different trades. I like to have separated trade accounts, whether you're a day trader or a swing trader or an investor. They're different strategies. The examples I'm using actually are correct for still doing smaller time frame trades. What you're doing is you're recognizing a trend. So for an example, I'm going to use the dollar index because this was an excellent trade that was taken only a little while ago. And what you'll notice here is we might break it down from a higher time frame. Now, I argued that we'd come into a level of position structure. Basically, we went neutral to bearish, and the bearish capability happened here. Now, as it pulled back, there was a trade that came in, and this particular trade is literally right in here, and it was a less than 24-hour trade. We're talking about 12 hours, and it was out. Now, how was it created? It was created understanding structure. It was created understanding breakouts. It was created understanding pullbacks, and then it was activated on the smaller timeframes here. So in that example, you would hold it for less than 12 hours, which of course would not hit your swap fees. But in general, swap fees or any of those types of things shouldn't really impact your trading too much. If you're a real scalper, so that means that you're on the super small timeframes. Let's go really small here into the 3-minute. This was actually activated on about a 10-minute chart. If we think about the market structure here, let's just say we got in to a trade. An example of maybe what a scalper would do, I mean, in my opinion, a scalper would target around this range here based on this left-hand side structure. And you would get in and you would place stop losses above here or here, or even above here if you waited for it to close or you picked it up around that area there. And you would just basically move it down. So same area would be where you're still attacking the trade, but you just wouldn't hold it as long. You would look at the instantaneous kind of pressure down here at 105.37, and that would be where you would exit the position. Okay, so it's just different time frames. Example for gold in the previous session, another one that was not held for very long but did come through, is actually a setup that happens on a 3-minute chart, and I have a higher time frame analysis that I like this level, and we get structural build, which is of course a position, and then we see a position switch, and that's something that activates a very small time frame trade. You just basically are looking to buy in here, place a stop loss below. How long are you in it? In this case, it was 2 days. Okay. Now, it could have been shorter. It could have actually been only a few, maybe half a day. There's no problem with that. It's just that it kept looking better after it created this structure over here. When that breaks out, what is that? Well, we know that's demand. And if it's demand or an accumulation area, then we can kind of say, well, there's probably a little bit more to come as it breaks out to the upside. And it turns out that news really helped this trade. John G says, thanks for the vid. No worries, John. Appreciate it. Trading Leprechaun says, thanks. I'm only 2 years into what I presume would be at least a 5-year journey. Can be a little while to get a handle on trading. So thanks in advance for covering in more detail. No worries. Thanks for asking the question. As I said, ADX is it's a complex topic that needs longer than just a 2-minute answer. As I said, I don't use as much anymore, but that doesn't mean it's not a good indicator. And I have seen a lot of people really wanting it recently. So why don't we cover it? Of course we will. So Trading Leprechaun, no worries. We will put that in the topics. So that's good. And is it a 5-year trading journey? You can speed up your trading journey. I would say 5 years is possible. If you're going to speed it up, though, you will usually need to consider doing some type of hopefully good learning. Now, of course, we do have a course at fxevolution.com if you're interested in ever looking at that. And we do a day trading masterclass, which I think would speed it up. But really, it's just about speeding up. That you've got to learn great kind of basic technicals and then more advanced techniques. You've got to understand market positioning, in my opinion. It's very important. And structure creation, market positioning is very important. Then from that perspective, you really need to put in a bit of time to see the tips and the tricks. There's a famous quote, I think, from Wayne Gretzky that says that you don't look at where the puck is going, you look at where the puck's going to be in the future. So basically, that's the difference in extreme athletes. That's not the exact quote, I get it, but you know what I mean? Like it's about being able to recognize, kind of like in chess, a few steps ahead. Avery says, how many years did it take for you and Tyrone to get sustainable profits in trading? A few, probably about 3 to 4 years. So it wasn't instantaneous. What did happen was it often does happen to all of us. So we have instantaneous success, and then you have to eke out like a couple of different trading styles usually before you get to the one that suits your psychology as well. So that is the thing. Not everyone's built for day trading. Some people are built for swing. Some people are built for investing. Some people are built just for literally position-based trading and looking for that opportunity. So yeah, it took a few years. David says, so which levels do I key off for actual intraday entries in the 5-minute and the 4-hour structure, or daily structure, or actual entry? Well, remember, 4-hour structure, daily structure will be pretty much the same thing, as in like you'll actually see it on both time frames. It'll just look bigger on the 4-hour or the 2-hour. So what you're looking for is generally, okay, so that is not an easy question to answer, David, because of course, it comes down to situations. So in an example like this one is you can see here that you've got this super uptrend. Where did the market stop? It stopped in this location here, and this location here, and this location here. So therefore, from a demand-based theory aspect, this location, and this location are all worthy of you looking at on the smaller timeframes. Now, did we get a reaction off that location the first time? The answer is yes. Did we get a reaction of this area the first time it came in? The answer is yes. So really the difference between you being successful oftentimes and other people being successful is going to be patience. And that's the bit that sucks the most about trading. You might say, well, Tom, I'm only trading a 3-minute, 5-minute chart. I don't care about your daily and your 4-hour structures and those types of 2-hour structures. Why do I care? I think you should care, because often you'll get slaughtered while the market is going through those levels of equilibrium to equilibrium. So I like to go and put myself in the best area, which is generally recognizing a higher time frame area of zone or position zone, and then I will have the patience to activate in that area, if that makes sense. Let me know if it does, David. But that's what I would be in this situation. That's the type of situation I'd be looking at. Trading Leprechaun, I'd be interested in a post with Pepperstone so I can take my trade to the next level. In a post. Not too sure what that means, Trading Leprechaun, but okay. And then Avery says, do you usually trade SPX or SPY? Okay, so the answer to that would be, if you're going to trade, generally Pepperstone has a great platform with US 500 as a code, which is a CFD. So generally that would be the one you would actually trade. because the CFD is a 24 by 5 and a bit market. So you've got that constant movement, constant ability to see position structure and all those types of things. Problem with the SPY is it's just an exchange traded fund. So it is only open for the time the market is open. So then, there are some extended hours, but you know what I mean? Like it's not open as much as a futures contract is or a CFD is. David says, so those 2-hour structures, what happens when the 2-hour is going down, but the daily is going up and you're watching a retrace on the 2-hour? Do you follow the 2-hour? Okay, so again, in this case, you've got your structures that you're looking at as the market comes back down to. Okay, so there's your market coming back down. So that's not going to really modify in this situation. It's a 2-hour and a daily structure, so it's the same thing. So if I just go to some random time in the past, I'm not obviously, let's just go back further just to understand it. Okay, so let's say I was analyzing this market here and I was saying which areas would I want to be looking at. And this is just based on a daily, but again, you can tell what's going to be happening. These aren't actually large daily ones, but I would look at this kind of level in here. If the market came down to it, I'd look at this doji. I'd look in these levels here, which has already been tacked. So that would be there. And I'd basically just line these zones up as points of interest, which I would then box and set alerts for. Now, if the market comes down to those areas, I would be then recognizing that. So say if the first one here, that doji, has been hit in here, and you can see this could be a zone which I was targeting for maybe a buy because the trend at that stage was bullish. All right. So the trend was bullish. So that would be the first one. The second one I would look at is this particular area in here, this box zone, which is quite large in range, but we would look at it. Now, you can see here, the market just goes straight through it. So the reason is that, do I still think that could have been a zone? Absolutely, yes, I do. But I want to have my activation correct. So what I think you'll find is that on a daily, there won't be much stuff stopping it. It'll just keep making a series of lower lows and lower highs and lower lows and lower highs. My suggestion, have a look at some of the other Pepperstone videos that we've done when we talk about trend change, and you'll recognize that that will prevent you from getting trashed on. Another thing here is that we have structure down here that we're focused on, and you can see the market starts to react to that. So that could have been a zone that we might have been looking at from a scalp-based perspective. And you can see it kind of structures around here. At this point, it tries to break to a new high, which is probably a little bit of a change of trend. So we're going to expect a little bit of a boost to come through, and we do get that boost. So at a few points here, I'd be activating. I'd be looking in here for longs. I would love that very much based on what I know on the daily. So I'd like to go for the bull position at that point. And of course, in here, I would have been looking, but that doesn't mean we're activating. So we have to, but they're the three zones that I would have been looking at. Avery says, when you started, who were your FX mentors? I didn't really do like FX from a perspective. I did a bunch of accreditations, so we're very well accredited in TA. However, that being said, and most of my stuff was also learnt about positioning from markets. And then, of course, I've done a lot of formal training as well. And I've been fortunate enough to speak to quite a few billionaires as well. Now, that's not to brag. It's just to say that they've helped me in my knowledge. And specifically, these are fund managers and stuff. So I've understood a lot about how they do things. And then, of course, the hours has helped. So the extreme amount of hours I've put in. Cool. All right. Well, thank you very much. Of course, there are always questions coming in here. Thank you very much for being a member of course, the Pepperstone community. And we hope you enjoyed this video. If you did, give it a big thumbs up, as I said. And here's the last question we'll do. For day trading, how many pairs do you recommend? And final question, there's a question on a question here. And final question, how many trades do you think per week for a single pair? For a single pair, it depends where the volatility is doing. If the VIX is above, let's say, a 20, so the volatility is above 20, then you generally will get a few more trades. For any given pair, it may be between 2 to 4, maybe 5 trades per week if you're being conservative and patient. How many pairs you'd be covering? Usually at the moment, when you first start, you want to be covering not too many. So I'd probably say between 5 and 10 would be your maximum. And that's just so that your head doesn't explode in terms of analysis. It is a bit of work when you first start to analyze. But as you get good and you improve, you will actually be able to find that you save a lot of your alerts into your charts and you actually do analysis, save an alert. And unless you're getting that alert trigger off, you're not going to be doing anything at all other than that. All right, guys, thank you so much for joining us here on the Pepperstone platforms. We very much enjoy doing these. As we suggest, you always let us know your feedback. And we've got some feedback about ADX today, so we'll make sure we do that in the future. Thank you, and bye for now. See everybody.